And if we do that and project it down, we can see that this could have a bottom target of around $3. This one right here is my favorite. This is the 61.8, and we can see that lines up perfectly with this triple top when we were in the handle.
Okay, ladies and gentlemen, so today we have Steve Barton from In It to Win It. And today we will discuss what's happening with the economy right now. We will talk about the commodity sector, precious metals, portfolio structure in the current environment, and many other very interesting topics. So Steve, thank you so much for being here.
Well, thank you for having me, Vlad. Glad to be here.
Thank you very much, Steve. So we have so much going on with the economy right now, with Trump putting pressure on Powell and so much. What are you particularly paying attention to, and what's your overlook on all the madness that's happening, Steve?
Well, I guess generally speaking, I think that we are going into an inflationary environment, and that's one of the reasons why I've been focusing so much on commodities, because usually, if you have an increase in the money supply, if you have more dollars in existence, then it's going to take more of those dollars to buy the same barrel of oil or the same ounce of gold. So I really like commodities right now. I think that the general market and equities are pretty overpriced. So I'm not interested in them at the moment. My main focus is going to be on commodities and precious metals. And I think they are going to perform really, really well like they have been. I think we still have a long way to go. And yeah, I'm pretty excited about those. I think we got a long way to go in the commodity sector. And so that's my main focus.
And are you paying attention, Steve, on the interest rates and what they're trying to lower them, to increase them, and everything?
Yeah, I could probably illustrate this a little better on the charts. I can pull up the Fed funds rate, and we can visually see what it looks like right here. So if I go here and I'm going to pull up the Fed funds rate, and we're going to focus here on the yellow line, and that's going to be this is basically the Fed funds rate, and this is going back to 1955, right? So we can see over here on this right column right here what the interest rate is for the Fed funds. Right now it's 4.33. Last I checked yesterday, there was over a 90% chance that Jerome Powell is going to lower interest rates on September 17th, so in less than a couple of weeks. And he's going to bring it down probably, a 1/4%. Now, what will be very interesting is if he just does it 1/4% and then does it again in October and then does it again. Is it going to be a waterfall drop like this? Is he just going to stair step it down? But basically what he's forecasting here is, this is the price of money on short duration. And, the cheaper this goes, I think the more inflation is going to happen. Now, the Fed isn't lowering interest rates here because they think the economy is doing fantastic. They're doing the opposite. They're lowering inflation because they think that the economy is about to hit a wall. He's using employment data as an excuse for that. That may be one of the factors. But if we can overlay here and we can just bring up the stock market, so I'll pull up the S&P 500 right here, and I will make that a different color just so that we can see it more easily. I'll just make it green. And we can see here, if we just go back to the last couple of cycles here, just overlaying this yellow Fed funds rate with the green S&P 500, and we can see they went in through a hiking cycle, and then here the Fed did a cutting cycle. And we can see that the S&P 500 fell down pretty hard when they were lowering interest rates, right? And that was in 2000, the dot-com bubble. Here again is the GFC, the Great Financial Crisis, and we can see they went through a hiking cycle, and then they cut interest rates, and the S&P 500 just tumbled right down, right? We could see this again in 2019. Now, this was kind of a quick blip, and the S&P 500 went up initially and then had a pretty good drop. Now, it went up here from like 3,200 down to below 2,500, so that's a pretty good drop from this one. And here we are again today. We have their first initial one. We got a little pop here in the S&P, had a little sell-off there from Liberation Day. But I think that the Fed is going to do what they've always done before, and they're going to cut. And I think the S&P 500 and general equities and markets are going to take a tumble from it. not necessarily because money is getting cheaper, but because they're lowering this because the economy is having a bad time. So that's what I see in the charts.
Yes, and would that in a way mean that we could have low inflation while that's happening for a while, and then once they're trying to fix that, usually with more money printing, then we have that inflationary spike that you're talking about?
Yeah, we could get bouts of deflation here, but I think they'll probably be pretty abbreviated. And so basically you get deflation from this. So you can't really think like, oh, the interest rate's cheap, so we should, have excess money. You got to think of it as like what's happening in the general economy. And when they're lowering interest rates like this, it's because people are unemployed and they're trying to stimulate the economy by making money cheaper again, but nobody is going out and buying stuff when they don't have a job. They're focused on paying the electric bill, paying their mortgage, and then buying groceries, and that's about it. Nobody's going to the movies. They're not having all this extra stuff. They're selling their stocks so that they can put food on the table, driving the price down. So I could definitely see bouts of deflation as we're going through here, but since the GFC, since the great financial crisis, they invented this quantitative easing, and I think they'll do the same thing again because that's just what they do. I mean, that's the track record that we got to go by. I think they're going to turn on the money printers and they'll just start printing again.
Yes, totally makes sense. So Steve, just before we move on to our favorite sector, commodities and precious metals, what's your view on the general stock market and the current valuations?
Okay, I knew you were going to ask this, so I pulled up just a quick Google search here. And okay, so here's the S&P 500 Shiller CAPE ratio, right? So current price divided by the average of its earnings over the last 10 years and then adjusted for inflation. And if we just look back here, so this is going back to 1871, right, all the way to today. And we can just see that it's generally speaking up at the higher end of the chart here, right? I would say generally if it's down here, it's cheap, and generally if it's up here, it's expensive. And the only time that we were higher than this was the dot-com bubble, right? So not all-time highs, but pretty high. And then if we go here to the S&P 500 PE ratio, we could see that, this is going back to the 1920s, and we could see that generally speaking, it's up at the upper end of that, right? It's not down here at the lower end of it. So those are some, just some real quick, easy charts that you can take a look at there. And then if I go here to the S&P 500, let me hide that, bring back my moving averages. It is a decently bullish looking chart in the fact that you have the moving averages in order. So the S&P 500 right now today is 6,400 or so. We've got the 20 moving average here and the 50 moving average here and the 200. So them being in sequential order is bullish. But what I see generally here is kind of a topping pattern, right? It looks like it's slowly making like higher highs, but not as bullish as it was like right after Liberation Day here. So if I look down here, this is the relative strength index, the RSI. And one way you can read this, you can't kind of think of this as like forecasting what's likely to happen in the future. And if we look at the RSI here on the daily going back to the end of July, we can see that the RSI was around 76. And there's where the price action is right up there. It was around 6,300, maybe 6,400. And then we go over here to the future, moving up a couple of weeks, the middle of August, and now the RSI is 68. So the RSI has gotten a little bit lower, but the price has gotten higher. And then we do it again, and we go over here, and the price has gotten higher, and the RSI has gotten lower. Now it's 64. Okay, so we went from 76 to 68 to 64, and over here on price, we went from what did we get there? We went 6,400, and then we go over here, 6,480, and then we go over here and we got 6,508. So as the price here is moving up, right, the relative strength index is moving down. All right. This is usually an indication that the price is going to follow. This is kind of the way you can think of like, this is kind of forecasting the future. Now it works the same way going the other way. If you have relative strength index moving up with the price going down, it can act as an opposite indicator. But what I see right now is I see it putting in on the charts, I see it putting in a topping pattern, which is likely going to move back down. Another thing too is September is historically a month where we have weakness. So now that I'm verbalizing this, now may not be a bad time, for this month, maybe buy some puts on the stock market, on the S&P 500 for a duration, I don't know, 2 or 3 months, something like that. That would allow you to sell out by the end of September, giving you a little bit of extra time. And most of the losses historically in September come kind of towards the later half of the month. So that might be a trade that you could put on it. Now that I'm talking about it, I should probably do it. But that's what I see generally in the S&P.
Mm-hmm. That's a great analysis. Thank you very much for that, Steve. And let's move to gold. Of course, the pet rock performed really, really well recently. And the fundamentals, I believe, still look good. So what's your evaluation of the current prices? And would you be bullish or bearish right now?
Okay, I don't know that I would be buying right here, although I think it's going up. So I'm kind of a bottom picker. You know what I mean? I'm not one of those guys like, here, I'll bring up the spot price of gold, and I threw this one out to premium subscribers. I'm like, look, this is a quadruple top right here. 1, 2, 3, 4. And on Friday, I was like, we're going up. Now the next leg we're going up to, I can run a Fibonacci extension here, and this is a really cool forecasting tool. And what you do is you basically, let me go to the futures contracts here, is you basically take it's kind of a neat little thing like we did with the RSI. So I'll take the lows back here of around $250, and that was back in like August of 1999, somewhere in there, just right around the dot-com bubble. And then we run it up here to the top of gold when it made that run all the way up to like 1900. And then we bring it back down to the bottom of the cup right here, and we forecast it out, and we can actually see the next levels that are coming up for gold using technical analysis. So this is just a real quick, easy way to do it. Fibonacci is simply it's a sequence that's found in nature. It's found in seashells and all sorts of stuff, and it works really well in technical analysis too. So you could see from here to there. Everyone, I think, watching your channel is pretty familiar with this cup and handle pattern right here. We've had that, and then we've had the breakout. But if you look right here at these different levels, you can see where these lines cross, and it is not a coincidence that we have some price action kind of following around where those lines are, right? So right here, this yellow one, whoops, undo that, there we go. This yellow one right here is the 50% one, and we can see that price action kind of hits around there. This one right here is my favorite. This is the 61.8, and we can see that lines up perfectly with this triple top when we were in the handle of gold. We hit it there, hit it there. This was the Russian invasion, hit it again, and then we finally broke out. And then there's a lot of price action around the 78.6, and then more price action here around the 100%, right? So this is a real neat forecasting tool. And the next level I see up, now I didn't get it exact here, but when I really got into the weeds, the number I got was 3,751. So that's the next level that I'm looking at for gold going up. I would expect it to get there. And then once it does get there, I would expect it to have some price action going sideways, kind of like we did around here, around 2,700, or kind of like we did here around 2,400. I would expect there to be a little bit of bullish consolidation before we move up to the next level after that. So that's what I see for gold. I don't know that I would be a buyer here. You know what I mean? I'm kind of a bottom picker that's like, okay, well, we all had 4 months here when we were in bullish consolidation, knowing that it's going to go higher, like pick these bottoms right here, ride the next one up, and then decide to trim when you get to the next level, But yeah, I think gold's going up.
Yes, I'm very similar to you from the perspective that I like to pick the bottoms as well. And if you look at that spike, I mean, it's so difficult to buy when you see something like that. If you just make it bigger, Steve, it's I wouldn't really be buying at these levels.
Yeah. I don't. Yeah. I
Mm.
don't either. I think that it's yeah, I'm just not the guy that can buy on that. You know what I mean? There are guys out there. There are TAs that like they buy this point right here and they forget and they don't worry about all this time right back here where it's not doing much. But I'm just not one of those guys. You know what I mean? Like I would rather try to catch these little double bottoms here, and I think maybe I'm just a little more patient. I don't know, but
Yes,
that's what I see for gold at the moment.
yes, and would silver show us a similar story?
Uh, Silver is interesting. Yeah. So if we run the Fibonacci extension again on using silver, so let me go out to the long-term chart here. Okay, so this is going back to the 70s. We got this pretty bullish looking pattern right here. And if we're going to run a Fibonacci extension on this one, rather than trying to run it way back here to here, we've had such a correction. I would prefer to run the extension on this one right here. So this is basically the COVID sell-off up to the COVID top, and then back down here when silver got down to like 18 bucks an ounce. And the miners, it was costing them about 19 bucks an ounce on average to pull the stuff out of the ground, and it was selling for 18. This was your back up the truck moment, and then we'll see what the extension is from here. But I'll run that same tool, and we'll go right down here to the bottom, and we bring it up to the top here, and then right back down and extend it out. And we can see that we're basically hitting right on the next level, okay? So let me do the daily, and then it'll be a little bit easier to see. Okay, yeah, so we can see there's quite a bit of price action right here, and this is the 100% retracement, so that was around $36, which it took us a while to chew through that, and you can see is acting as support and resistance here for a while, went back up, came back down right to it, and now we've gone up to the next level. The next level here is around 41.50. Okay, and that's going to act as support now. See, we've broken above it here. If I zoom in here, you can see the bar is a little bit bigger. We've broken above this level now. Now this will act as support to move higher. If it breaks down below this, this will act as a roof to kind of stop it. But what I really like about this level is if we go back and we look at the price action back here in 2011 when silver had that massive run up, and then we go back here to the 1980 run-up, all of this action right over here was kind of a blip in time. You know what I mean? This was your chance to get out. You didn't have a whole lot of time to do it. You had a couple of months at best. So we can't go by this price action too much, I don't believe. I think most of the price action we got to go by, if we're going to use it as support and resistance, is going to be right over here. Because we're kind of in uncharted territory here. We've had a lot of inflation since then. There is no price action over here because it hasn't been done in like 14 years, right? So this is the best we got, and there's very little over here. So I see very little resistance on the way up to $50. Our 1618 level right here, which is a pretty powerful level in Fibonacci, is around $48. Lines up pretty good with the previous ones. Everyone says 50 bucks, 48, whatever, close enough, right? So I don't see much resistance at all here on the way up. I see a tiny bit at 44, which lines up pretty well right back here to August of 2011. But that's about it. You know what I mean? We have the all-time high of 48, 50 bucks. And beyond that, I fully expect this bull run in precious metals for silver to hit levels well in the triple digits, probably in $150, $250 an ounce, somewhere in that range before we're finally, time to take real profits off the table. Yeah, I'm not selling any here. I'm also not buying any. I want to wait for some kind of consolidation. I want to wait for some kind of pattern that's tradable. When I just see a spike of price going up like that, it's not tradable to me. Little patterns that could be tradable. You have a little bit of a bull flag right here. Okay, so that's tradable. You could have this going up like that. Okay, that's forecasting that it's going to go up, so that's tradable. There were some other bull flags in here. You had a little tiny one right here, and then you had another little one right here, and then you had another little one right there. Like all of those are tradable, but when it's just spiking up like this, I feel like you just kind of got to be patient, hang on, don't sell. Just wait for this. This wouldn't surprise me at all if we kind of get some bullish consolidation like this going up. Now that would be a tradable event. But where it is right now, just wait and see where it falls, wait and see where it goes, and then find another pattern where you can find an entry point.
Yes, that makes total sense to me. And Steve, would there be any other commodities that you would be interested in right now?
This is the copper chart. So some of this I think we have to negate because this was the Trump tariff on copper. I think he basically said that they're going to put 50% tariffs on copper, and then he said, no, we're not. And, so some of this you have to discount here and kind of forget about. But that also being said, in technical analysis, this is a bear flag right here. And some of the, what's the word? The way we can measure these, just like with bull flags, take our handy dandy little target tool, and you basically take the pole of the flag, and then you move it down and extend it down. It would break out to the bottom side of this. And if we do that and project it down, we can see that this could have a bottom target of around $3, which sounds kind of insane because copper's trading around 450 right now. The charts are saying it could go down to 3. I kind of discount this pattern just a little bit because I feel like this was more of like a tariff-induced one. If we didn't have any news about the tariffs and like that, then I might put a little bit more stock into this. But because we did, I put a little bit less of it. But it is a bearish looking pattern, and usually when you have flags like this, they play out 65% of the time, something like that. So I think it's more likely that copper goes down than it goes up. But as far as copper equities, one that I think just about everyone can play is COPX. This is a copper ETF, and although I don't see any buys on it right now, we got pretty high in the RSI, up at 74 on the daily here, and anything above 70 in the RSI, generally speaking, alarm bells should be going off in your head like, hey, probably not the best time to be buying right here. This should be the time that you're selling. Anytime it's down around 30 is the time where you should be buying. And you can line these up right here, and you can see that down here the RSI was 24. Nice little Liberation Day sell-off right here. And right up here the RSI is 74. Maybe it's time to take a little off the table. But as far as like buys right now, I was looking through before we hit record, and I don't really see any deals except possibly this one right here. This is if you want to get into coal, this is the only coal ETF that's available to my knowledge. We didn't have one for years, and then these guys just started one up. This is a pretty bullish looking pattern here, actually. One thing I do not like is that the RSI is going down and the MACD is going down. But one thing I love here is this lighter blue line right here is the 50-day moving average, and this darker one is the 200. And so when you get the 50-day moving average crossing above the 200-day moving average, that's what we call in technical analysis a golden cross. And it kind of makes sense. I mean, the way these averages are calculated is you take the closing price of the last 50 bars and add them up and divide by 50. And that's the point right there where they would all add up, right? So that point right now on this coal ETF fund is right over here, and it's $19.54. And then you do the same for the 200, right? So you add up the closing prices of the last 200 bars, and you get a price of $19.18. So it makes sense that if a stock or commodity or whatever you're looking at on the charts, a ratio is a lower moving average is crossing above a higher moving average, it makes sense that it's in an uptrend. And vice versa, if a lower moving average crosses below a higher moving average, it's in a bearish downtrend, right? So this to me looks like we've kind of put in a basing pattern here in coal. And this is just a coal ETF. I think they have 38 different coal companies in it. And it's a really easy beta way to play coal. And I think now is a pretty decent time to buy it, actually.
Yes. And Steve, I can't take off my eyes from that plunge in May that we had on coal. That just looks...
Oh, right over here?
Yes.
Yeah, I missed this one. I should have bought right there. And it was... This was another one of those events like when oil went negative in COVID, and I was, I don't think I ate breakfast any one of those, just completely glued to the screens, trying to find the deals. Are we missing something? Me and my buddies on speakerphone the entire time while the markets are closed, like, what is it that we should be buying right now? Because we need to be buying something. And, it just comes out, you can't kiss all the girls, you know what I mean? Like, you miss some stuff, and this was one of the ones that I missed. But yeah, I missed nickel at this one. I caught a lot of stuff. I caught a lot of uranium. But at some point I just didn't hit everything, and yeah, that would have been an amazing buy. But at that, I think we're going to get more of those. I think with the Fed cutting rates, I think with all these tariffs. I mean, there's news right now of maybe even the tariffs aren't legal. It's going through courts, and they're saying that they can't do it. We'll see what the Supreme Court says. But, there's a lot of things that I think we're going to see coming up in the next year, 2 years. I think we're going to see more sell-off, washouts, spikes to the downside like this, and also ones to the upside. But those are moments of opportunity, and you got to be willing to take advantage of them. Calling sick to work, do whatever you got to do to take advantage of these things. Like, they don't come along often. And when they do, you got to pounce. You got to do it.
Yes, and so with that being said, Steve, with everything that's going on, how would you think about building a portfolio in the current environment?
I would start with the way I work on these commodities. Let's say you want to start with gold. Okay. The easiest and I think the safest way to do that and the way to establish your position is start with a physical position. Now, whether that means, buying coins and bars and, taking on the storage risk, or what I like to do is simply click a mouse and buy them off of the stock market. So here's one fund, PHYS, and you can see if I click between the gold chart here and I click between PHYS, pretty much a carbon copy, right? So you start with the least risky one first, and you start with the physical commodity. You can do the same thing with silver down here. So PSLV is another physical fund, and if I click between the spot price of copper, the futures price of copper, and then I click on PSLV, pretty much a carbon copy, right? So you can get exposure to physical bullion. You can get exposure to these things by betting on the physical commodity first. After that, I like to go down the risk curve, and I like to bet on the miners that are actually looking for this stuff, the royalty companies, right? So after betting on the physical commodity, I would get into some of the biggest royalty companies and the biggest miners on the planet. And then after that, if you want to do even more work, then you can get into some of the mid-tier mining companies. And after that, if you want to do even more work, you can get into the developers. And then if you're really crazy, you can get into some of the junior mining stocks. Okay, now that this is where you're betting on things that, in any moment, a government could shut them down, highly, highly risky. But we had one in the portfolio recently that in 6 weeks went up over 160%. So you can have some radical gains, but that could also go to zero, so you gotta be willing to accept that risk. So start with the physical, move on to the big major mining companies first, then work your way down the value train. And it basically, that's the way I would look at it. And then you got to come up with like, okay, what percentage allocation do I want in each one of these things? And so, I feel pretty good about gold. I think that I don't think it's likely that they're going to balance the budget. I think it's very likely that they're going to keep printing money. So I have a pretty big percentage of it. I've got over 20% of my portfolio just in gold and gold stocks. So for you, I would look at like, what commodity do I think is going to do well? Invest, in the order that that I mentioned, and then decide what percentage allocation do I want of my portfolio to this commodity, and break it down from there. And then also, you and I were talking before about having a cash position. I think that is extremely important right now. When we look here, this is the VIX chart. So this is basically, it's called a fear index, or it's the volatility index. And basically the way you can look at this is when this spikes right here. So this spike right here was Liberation Day, right? So this is when stuff is getting really cheap or really expensive one way or the other. There's volatility, there's fear, right? And the way we've been going here for the last little while, it just kind of looks like a dying heartbeat. That means that there is no fear in the market. And when there's no fear, all it takes is some little thing to come along and, the tariff on this, and then this thing is going to spike to the upside. So I think right now you need kind of a healthy cash position, because I think something's coming. I think deals are coming, and you want to have that cash to be able to take advantage of it.
Yes, that's a very good one. But what's interesting as well is that VIX is very low, but gold is continuously improving. And I feel like that's a very good sign for gold as well, because it is a hedge at the end of the day.
Yeah, that's a good point. I never thought of that. But yeah, you're right. I think a part of it too is they're pricing in the Fed cut that's coming in. Like when you go on the CME Fed Watch tool, like 9 out of 10 traders are like, yeah, he is cutting here on the 17th of September. And so I think some of that is pricing in. They're like, okay, money is getting cheaper. The Fed is capitulating, and they're sacrificing the dollar, the reserve currency, to do it. So it's going to take more of those dollars to buy the same ounce of gold.
Yes, that's true. And Steve, I like to ask this question for the younger audience. If we have an individual who's still at the beginning of his and her wealth building path, they have so many options with everything, with the cryptos, with the bitcoins, the commodities. What advice would you have for that individual on how they could start their wealth building path the right way, and maybe avoid making too many mistakes?
I suppose I would start. Well, first you got to start by saving. So I would say the minimum is for every $10 you make, you save one for your future retirement. Throughout my career, I've saved a lot more than that. I've saved somewhere 25, 30%, somewhere in that ballpark. The lowest I ever got was because just of life, I got down to 5%. But I would say at minimum, start with 10 and invest it into something. Then I would look at where you are physically located on the globe and what tax advantaged accounts you can invest in depending on where you live. So for example, I live in America, and one tax advantaged account that we can have is called a Roth IRA. So you pay taxes on this money before it goes into this account. And then after that, any gains in that, you don't have to pay capital gains tax. It is all yours. There's usually some stipulations. So like with the Roth IRA, you can't withdraw that until you're 59 and a half years old. But, it's a really neat way to, bet on some of these like junior mining stocks that can have astronomical gains. And you already paid taxes on that money that you put in that account years ago. So everything in there afterwards is yours. And most countries have some type of tax advantage account like that. I also think that, as far as it may not quite go into the investing thing, but having a home, one that you're not renting and one that you own is really important. And the way I look at that, in America, we're pretty lucky in that we have what are called 30-year fixed mortgages. And so that basically means you can lock in an interest rate and a payment, and essentially it's the same for 30 years. So once you lock it in and the government runs away with all their inflation, your mortgage payment stays the same going 3 decades out. Not every country is that lucky. Look into what it is for you. But, having a home, a place that, you have, where you can feel safe and secure and you can set up camp for as long as you want, I think that goes a lot towards like having a good mental psyche to be able to like branch out on investments like that.
Yes, that's a very good one. Thanks for that, Steve. Steve, could you tell us a little bit on your technical analysis course for beginners as well?
Yeah, I did a technical analysis series for beginners, and it's basically a 3-hour course, video course of me pulling up the charts and showing, exactly what it is that I'm looking at, like we did with the Fibonacci extension with gold, teaching you the patterns that I've found that I like and that I use to kind of forecast where things are going next. I'm getting a lot of positive feedback about it. And, I think a little bit of this can be kind of intimidating because, you're like, well, how did he set this up? Like, what do each of these lines mean? The first 30 minutes of those 3-hour videos are me showing you exactly how to set up the charts like this. So we go click by click, mouse click by mouse click, and I show you exactly how to set all of these up so that your screen looks exactly like this, or you can tailor it to whatever you want. If you want this line to be green, whatever, then you can go into settings and change it. I show you all of that. And then from there, we go into the different chart patterns to kind of predict, which way is the stock price going? Is this a buy or a sell? And that's, yeah. So if your viewers want to check that out, if you could put a link down below, they can see if it's for them.
Yes, 100%. And technical analysis is very important. I myself like to combine the fundamentals and the technical analysis because I believe it strengthens your thesis, but also it can tell you the fundamentals usually tell you what to buy, but the technical analysis tell you when to buy. So it's a great tool, and I highly recommend it. So I will have the link in the description. And Steve, these are all the questions I had. Is there anything else that maybe we haven't mentioned that you would like to say?
Well, thank you very much for having me on. So I've got a YouTube channel as well, In It to Win It. If you're new to charting, check out the Technical Analysis for Beginners video series. I also publish a free weekly newsletter with market recaps, and I have a premium newsletter where I share the exact stocks that I'm buying and selling with real-time trade alerts and a quick video showing you how I found that and when I'm buying and selling. So you can find everything, my channel, newsletter, other resources, right on my website. It's stevebartonmoney.com.
Steve, it was a pleasure having you, and thank you very much, sir.
Thank you.